webinar, we'll go ahead and get started. My name is Greg Johnson, and I'm the head of Multnomah Group's Technical Services Committee. This is one of 3 committees at Multnomah that were created to help monitor various aspects of the retirement plan and asset management industry. The 2 other committees that present webinars periodically as well are the Investment Committee and the Vendor Services Committee. So the Technical Service Committee seeks to provide webinars throughout the year on different subjects of importance to retirement plan sponsors. These typically involve legal updates, legislative updates, and often plan compliance information. So today we're focusing more on plan compliance type of information, specifically to 457 plans. A couple housekeeping items. Everyone on the webinar is muted. However, we do want to take questions. So if you want to ask a question, please use the Q&A function at the bottom of your screen. Also, we will be sending out the presentation to everyone who registered at the conclusion of today's webinar. So I'm pleased to introduce Brian Mañez, who is a senior consultant and principal of Multnomah Group. You heard us commenting about our tenure in the industry, and I know many of you already know Brian, but he has over 25 years of experience working in securities, investment advisory, and the retirement services industry. And he will be today's presenter. So Brian, I will turn it over to you.
All right, thank you, Greg. So today's topic is a focus on tax-exempt organizations 457 plans. I do want to note, and I'll say it somewhere else, these are not for the governmental plans. These are just for 457B, 457F for nonprofit organizations. So why are we here talking about this today? So back in 2013, the IRS announced it was going to undertake a compliance check on 457B plans specifically. As a result, the IRS audits of 457 plans have increased in the past few years. I'm noticing it with my own client base. So we thought we would do a review of 457B plans, 457F plans, and compare and contrast them. So when the IRS comes in to audit, what they have been looking for, I've outlined here. So whether the plan's been timely adopted of the original plan documents, I have noticed as I bring on new clients, documentation of 457 plans can be challenging. Whether a group of employees has been properly limited to a select group of management or highly compensated, and that is the nature of a top hat, non-qualified 457 plan, is that it's limited to a select group of people. Whether there has been compliance with the annual contribution limits and special catch-up rules, and this is probably the #1 problem I've seen with client work. Whether there's been compliance with the rules governing the time and manner of distributions, and whether loans have been impermissibly allowed. Timing of distributions, they're different than qualified plans, than 457F and 457B. They're all different rules. Whether FICA and income taxes have been properly and timely withheld, paid, and reported on contributions and or distributions. And we're going to go through how to handle that today. And whether the top hat notice required by the DOL regulations was properly filed. I know I said limitation on employees is probably the #1 issue, but that's an administrative issue. At the birth of a retirement plan, at the birth of a 457 plan, so today we're going to go through eligible employers, why plan sponsors offer these plans, the application of the IRS and ERISA, eligibility, security of assets and funding of plans. Again, funding of plans can be different with these. Contribution limits, vesting, taxation, investment options, and then general questions. So eligible employers. So these non-qualified deferred compensation plans are for employer-sponsored plans of 501c3 or non-governmental tax-exempt organizations, and limited to a select group of people. Again, these are not governmental plans. I do work with governmental plans. I'd be happy to talk to you about that, but that's not the focus of today's conversation. Generally, those who participate in 457B plans plan to defer so contribute. Generally, those who participate in F plans have the employer contribute, but are eligible to defer up to 100% of their salary, but that's risky. Why? If you don't meet your vesting event in a 457F, you forfeit the entire account balance or the entire balance that's subject to that vesting event. Money as well. 457B plans tend to be more where people put their own money. 457F tend to be where employers put money. 457Bs are defined contribution plans, so like a 401k or a 403B. And 457Fs can be a defined contribution plan, but it can also be a defined benefit plan, depending on the executive benefit you're trying to achieve. Why employers offer these plans? To help participants save for retirement plan to their senior people. They may be fortunate enough to make higher than the $285,000 IRS limit on definitions of compensations in a traditional qualified plan. So if you have a 10% match on your contributions in your 401k plan, and you have a senior executive who's making over $285,000, they're not getting the 10% on their full compensation. They're only getting the 10% on that first 285. So 457 plans can be a way to make a participant whole in terms of the employer contribution. They're also used to provide a competitive benefits package when recruiting key employees. So you can use these as enticements, extra benefits to bring on certain employees, and or retain employees, the idea of the golden handcuffs. So I said vesting earlier. You can put a vesting schedule that is designed to keep a key employee in place for a specified period of time. Those are the three main goals, and we'll kind of touch on it again when we get to contributions.
Hey, Brian, can I interrupt you for a second?
Yeah.
You were breaking up a little bit there. I wonder if I can take over if you can stop sharing, and then I'll share my screen. It might take a little bit of bandwidth off on your end. All right, I should have it now.
All right. Yeah. Sorry, folks. Murphy's Law. In the past 2 days, I've started having connectivity issues. If you go to the next screen, please. So eligible employers. Next slide. I think you went backwards. Correct. So there we go. So application of ERISA and IRS. Four, 5, 7 plans are non-qualified. Therefore, they're not subject to non-discrimination testing. That's one of the first questions I always have to address is, well, can we give different benefits to different people? With 457s, yes, because they're not tested as a standalone plan, and they're not tested with your other plans. There are no non-discrimination testing. So you can give somebody X and you can give somebody else 5X. That's completely fine. 457 plans are not subject to ERISA, but do have to file a top hat exemption letter. It's basically a birth notice. The Department of Labor wants to know that a 457 plan exists. They don't do anything with that information. They're not going to come back and audit you just because you filed an announcement. They want to know that you exist. So for those of you that do run 457 plans, I would encourage you to go to this search engine here. This is a DOL website, and you can see if your plan did in fact file the birth announcement with the DOL or not. If you did not file that birth announcement, I encourage you to go to the DOL website and look at their delinquent filer voluntary compliance program. Maybe you can do it on yourself. Maybe a TPA can do it. You might want an attorney to help you file it, but this is a correction program. It's very cost effective, and it will get you out of a lot of trouble if the DOL ever does come knocking. So you can go to the search engine and find out if you filed that top hat exemption, and if you didn't, I encourage you to go to the DFVCP. 457 plans must limit to a select group of people to maintain tax favored status. That's what the IRS says. That's the deal. You'll limit this to a select group of people. We'll allow you to put more money in than you normally can. subject to substantial risk of forfeiture. Again, that's the deal you make with the IRS. We'll allow you to do this, but it has to be subject to substantial risk of forfeiture. Substantial risk of forfeiture is defined down there. Loosely, what it means is if you leave before this event hits, you will lose your money. So if I want to hire a CEO, keep that person around for 10 years, I can put a 10-year vesting schedule. And if they leave before that 10 years, they forfeit all the money. Greg, next slide, please. So source of plan documents. So 457Bs can usually be, a document can usually be provided by your record keeper or whoever it is that's going to administer the plan. They're boilerplate checkbox documents, 6, 7, 8, 9 pages long. They're pretty simple. But a 457F usually is a custom drafted document by an attorney or part of an employee's contract. That's significant because, as you'll see, I say a separate plan document is not necessarily required for a 457F. A 457F can have a separate document. That's perfectly fine, or you can write it into the compensation agreement. There is specific language that has to be included in that employment agreement if you want to use that as your contract. Absolutely encourage you to work with an attorney to make sure you get the documentation correct. But if you can't find your 457F document, look at the employment contract for those specific individuals. Next slide, Greg. So eligibility. Okay, now we're getting into some of the fun stuff. So 457 plans generally limited to a select group of management or highly compensated employees. While there's no formal definition of select group of management or highly compensated employees, it generally means a small fraction of the employee population. Here we have a couple lists coming off the IRS website, and I sourced it there. So are they key management employees? Do they earn a salary substantially higher than that of other employees? And over the years, the courts and the Department of Labor have looked for one or more factors, such as total number of employees, average salaries of employees, average salaries of a select group of people, ranges in salaries of the select group of people, and the extent to which the group can negotiate salary or compensation package. And that last one's a nice qualifier, because if you can negotiate your salary with your employer, you're probably a select individual. Informal guidance says limit to 10% of less full-time employees for the 457B plans. I say that because the 457F, again, tend to be employer funded, and I doubt very much your organization wants to give extra benefits to 10% of its entire population. You would just do that via compensation. But a 457B, limit it to less than 10% of your population. 457F plans generally are further restricted to only the senior most employees or a targeted hire. So yeah, you can use 457Fs to keep people or to get people. Next slide, Greg. Security of assets and fundings of plans. This is very key for the participants. Unfortunately, I hear when I start working with new clients, a lot of people don't understand the lack of security that the participant has with their deferred compensation plan. So 457B and 457 plan assets are held as part of the general assets of the employer. Yes, they belong to the employer. The plans are subject to attachment by creditors of the employers, even in bankruptcy. So if I have a 457B or F deferred compensation package and the employer goes bankrupt, I can lose all my assets because those assets can be subject to creditors. But there is a security mechanism that can put in place a small measure of protection. So if you think about it, if the assets belong to the employer, then the employer can kind of do whatever they want with them, right? And in theory, the employer could spend that money and not have it there for you when you do reach your benefit. A rabbi trust can be the answer. A rabbi trust is a trust established by an employer to provide a source of funds which may be used to satisfy the employer's obligation to the executives under the non-qualified plan. So a rabbi trust simply sequesters the assets and allows those assets only to be used to pay that specific benefit that cannot be used to invest in property, plant, equipment, or even the next payroll. So it sequesters those assets for the specific purpose. Funding of plans. So 457B funding, but not necessarily self-directed. So yes, you will put the money away, but the employer may invest those assets or the employee may invest those assets. A 457F may or may not be funded. It can be self-directed or not. The employer can put the assets aside, or the employer can just accrue it as a liability on the employer's balance statement. 457Fs have a lot more flexibility. Next slide, Greg. Contribution limits. So this is where they really diverge. The 457B is subject to section 457E15. It's the same thing as the 401k salary deferral and the same thing as the 403B salary deferral. So 19,500 this year. It keeps in lockstep with those numbers. For the 457 employer contributions, so I'm just going to go down the 457 and then the 457F. I'm going to do the B first. So employer contributions can be fixed, such as a 5% of salary. Discretionary, at the end of the year, will make the contribution, or determined separately for each individual participant. Again, since there's no non-discrimination testing, you can do whatever you need for that one particular employee. Employee salary deferrals or employer contributions, or both. Contribution limits apply to salary deferrals and employers combined. So if I'm going to put money in and the employer is going to put money in, I'm still subject to that $19,500 limit. That trips up a lot of employers. They still think that, like a 401k or a 403b, the employee can put in 19.5. No, 19.5 is the absolute limit, either coming from employee or employer. And these monies don't count towards the maximum annual contribution limits under 401ks or 403bs. So I can do my 19.5 in my 401k, and I can do 19.5 in a 457b. But the Bs don't have the age 50 catch-up, but they do have a rather confusing special 3-year catch-up provision. Check your plan document, see if you even allow it, and if you allow it, then it gets a little difficult, because what the rules say is the 3-year catch-up provision allows individuals within 3 years prior to the year in which they reach the plan's normal retirement age. So check your plan document. What is the normal retirement age in the plan document? It's 65. Okay, so at 64, 63, and 62, I can do a special catch-up. In English, what the catch-up is the lesser of all the deferral limits that were not used historically. So if I only put in half of the 19.5, then I get to catch up with that other half, or one time the annual limit, 19,500. So it's the lesser of what I didn't use historically up to a maximum of 19,500. But again, that's on the 3 years prior to the year in which the employee reaches normal retirement as defined in the document. On the F side, employer-only contributions can be fixed or discretionary and determined separately for each covered executive plan. With 457Fs, the contributions have to be spelled no dollar limit. So I can put in X, 2X, 4X, whatever it is I need to put in for that particular employee. The limits don't count towards the maximum annual contributions like with the F. They're not coordinated with the 401k or 403b. And rules suggest that executives must perform service for at least 2 years in order to be eligible to receive benefits. So you can't just bring someone in for a contract hire. They've got to be there for at least 2 years performing service. Next slide, Greg. Vesting. So in a 457B, the employee is always 100% vested. I should say, yes. And vesting allocates to the limits could create problems with annual deferral limits. So if you put employer money in and say put a 5-year vesting schedule, when that employee vests in the employer money, the amount that they vested is going to count towards the 19,500 limit. So if you give them $10,000 a year and put a 5-year vesting schedule on it, in year 5, they're going to vest $50,000. Well, you just violated the allocation limits of 19,500. Vesting really does not work with a 457B because when it vests, it counts towards that $19,500 limit. But with an F, that's different. The golden handcuff rules. So an employee is 0% vested until they reach the predetermined vesting event. The vesting event is always spelled out in the document. Doesn't have to do with when they terminate employment. Doesn't have to do with their age. It is either a number or an event spelled out in the document. Vesting is tied to the duration of service. Vesting is tied to the duration of service and or the occurrence of a condition that is related to a purpose of compensation. So we want to bring you on to manage the acquisition and implementation of this new organization that we're buying. So we're going to bring the old CEO on for 5 years. We're going to give them a deferred golden handcuff that vests at 5 years. Hey, Greg, I saw a question pop up on my screen, but it flittered away before I could get to it.
I'm looking for it right now. Keep going, and once I get it, I'll let you know.
Thanks. If executives voluntarily terminate employment prior to the vesting date, all the money's gone. Again, that's why we don't see salary deferrals into Fs, because if they get into an argument with management and they decide to leave, they will have forfeited their own earned compensation. Vesting equals taxation. When it vests, as in when the plan document says the employee can get it, it's taxed whether or not the employee takes the money out. Greg?
All right, we're going to go back here. Question on the 3-year catch-up. For the 3-year catch-up contribution, is the limit the total for the 3 years or a per year limit for each of the 3 years?
Total of the 3 years or a per year? Oh no, individual limits. Yes. So last year it was 19,000. The year before it was 18,500. The year before that it was 18. Yes. So it's the deferral that wasn't used given those individual calendar limits.
Okay. You know, my only comment on that 3-year catch-up is, you know, you probably want to understand it very well or speak with an attorney if you have someone that's going to use that limit. Sometimes I compare it to the 15-year catch-up in 403B plans. You know, I don't particularly like provisions that can easily trip someone up. So if you are going to use that, you know, make sure you're doing it properly.
And make sure it's in your document. It's not always a provision in the document. So if Greg were your consultant, the plan sponsor, the client might say, yeah, you know what, that's confusing. I don't want to put that in my plan document. And then the next benefit administrator comes along and says, yeah, you can have this special catch up. So read your document.
Well, and even not to hammer it home too much, but even that normal retirement age, you know, if your plan says normal retirement age is 65 and your 66-year-old president says, hey, I'm going to start using this catch up, it's too late.
That's true. Yeah. You can't do it once you hit it. All right. So I think we're on 12, Greg. All right. So distribution rules. I'm going to compare and contrast. So I numbered them. I'm going to go 1 and 1, 1 and 2 and 2, 3 and 3. So distribution rules for the 457B, payable after termination of employment, which is cool because as long as I'm working for the organization, I can continue to defer money. There's no vesting event that's going to force me to take my money or taxation. It happens when I terminate employment. But for an F plan, it's payable after that vesting date. And again, it's in the document, no early withdrawals of any kind. And that vesting date is usually tied to a number of years or some specific event. But once that vesting date happens, the money can be distributed. Doesn't have to be distributed, but it does have to be taxed. Number 2, no in-service withdrawals, but unforeseeable emergency withdrawals are available. They're basically the same thing. The language is a little bit different. So small I, small s in service, yes, but read the document to see what the unforeseeable emergencies, how they're described. And 457Bs do have RMDs. Most people don't think they do because they're a non-qual plan, but they do have required minimum distributions. A 457F, no in-service withdrawals or unforeseen emergency withdrawals. Employer-sponsored plan, but may be transferred if both plans allow transfers. From the participant perspective, it's the same thing, a rollover or a transfer. But the money has to go directly from one plan to the next plan, and both plans have to allow that feature in their document. So the plan you're in has to allow transfers out, and the plan you're going to has to allow transfers in. And if you think about it, because the money is distributed at termination, you're going to have that next job set up really quickly, and I'll talk about that in a little bit, to get that money over before it's forced out of your plan. Number 3 for Fs, not eligible for rollover to IRA or to another employer's sponsored plan. That's it. When it's vested, it's yours and it's taxed. Number 5, absent a written distribution election. So when I terminate employment, if I don't put in writing how and when I want the money, the plan must pay the assets as per the default distribution rules in the document. It's usually a lump sum in a 90-day period. So if I don't put in writing how I want the money, it's going to be paid out in 90 days. For 457Fs, number 5, distributions are prescribed by the plan document. Employees have limited options to alter the structure and or timing of the payment. You're probably getting the sense of Fs are very, very specific. They're very generous, but they're very specific. Number 6, you may make a one-time additional election for a 457B to defer but not accelerate the receipt of benefits if the election is made before the distributions have started. So I can't be in distribution and then say I want to defer it. I can defer it in writing once before the distribution begins. For the 457F, now we're going to get really complicated. So you may make a one-time additional election to defer but not accelerate the receipt of the benefits if the election is made 90 days before the distribution of the initial deferral election. However, it must be a materially greater benefit after that distribution, meaning it has to be more than 125% of that benefit. So what that really means is the employer is going to have to fork over more money to increase your benefit so that the future benefit is more than 125% of the initial distribution that is being deferred. So if this is an ongoing employee and you have a vesting event each year, the fact that this person is going to be around for 3, 4, 5 more years, that may naturally hit the 125% benefit because in future years you already have a plan to make a contribution to them. But if this is their final money from the employer, and probably not going to be an option. So read the document, talk to an attorney, call me. This gets very, very complicated in terms of what it functionally means and how to implement it. And you have to defer it for at least 2 more years of service. So it can't just be that the employee has stopped working, they've ended their contract, and they want to defer it for 2 more years. No, you have to still be working for them. So 457F deferrals of the initial distribution, they can be kind of complicated. Number 7, distributions for 457Bs. Distributions can be structured in many ways over many time horizons. Annuity, systematic, partial, lump sum, whatever you need. A 457F, distributions are prescribed by the plan document. Can't alter them. I will get an annuity. I will get a lump sum payment. I will get a systematic withdrawal. It's defined in the document. And loans for 457Bs, nope. And for 457Fs, nope. Very simple. Next page, Rick. Taxation. We've talked about taxation a lot. They're very different for 457Bs and for Fs. So for the B plan, the contributions are taxed at federal and state when distributed. So I'm going to get a W-2 when I take my distribution. For 457B, contributions are subject to Social Security and Medicare taxes currently as if the employee had received the compensation. The employer must withhold FICA and FUTA at the time of contribution. So when I put money into a 457B, you got to withhold FICA and FUTA. From a W-2 perspective, many vendors will issue a W-2 for you. If not, it's going to have to be run back through your payroll system. And when as I just said, when vendors can't or won't issue a W-2, you're going to have to run it back through your payroll. Most of the major vendors will process a W-2 for you. On the F plans, the entire benefit is taxed when vesting occurs, including FICA and FUTA, not at the contribution or distribution date. Remember, I can vest on one day, and that's when it becomes taxable, but I may elect not to take that money out. I may elect a later distribution date. So taxes are due when it vests. Taxation occurs at vesting regardless of whether the benefit is paid. And all distributions are treated as wages for federal tax purposes and reported on W-2. Therefore, benefits are usually paid out at the time of vesting. What's worse is, imagine you have a vesting date, you decide to defer receipt of your money, you pay taxes today, and 2 years from now, the company goes bankrupt and you lose the money. So you'll have lost 135% of whatever the benefit was because you paid taxes and you lost the benefit. Next slide, Greg. Okay, available investments. This is also interesting to me. So first off, talk to your vendor. Whoever the record keeper is, talk to them. I say that because from a business practice, they may limit the type of investment vehicles. As a business practice, they may require a type of investment vehicle. So talk to your vendor about what you can do. Stable value products may or may not be eligible depending on the investment product registration. Now, I said stable value, which is an SEC registered product, but there are a number of synthetic stable values out there or insurance contract stable values out there. They look, act, and feel like a stable value, but based on the way they registered with the state or federal agencies, they may or may not be eligible in a 457B. So talk with your vendor about available options because business practices and registrations will limit what you can and can't do. For funded plans, funded with a rabbi trust, and this comes from a trusted attorney that I work with, any objective or market-driven investment can be used that offers a reasonable rate of return, so I can't guarantee my participants 100% return. And here's the kicker, available to the public. So it can't be any obscure private relationship that you have. So any objective and market-driven investment offers a reasonable rate of return and available to the public. Practically speaking, you're talking about mutual funds and brokerage accounts. Sure, some organizations will use variable annuities, not as many as you might see, but practically speaking, it's going to be mutual funds and or brokerage accounts. Funded plans, remember, are going to be 457Bs, and funded plans may or may not be a 457F. But a 457F may be an unfunded plan. So for the investment vehicles, if it's unfunded, we're not putting the money away. We're not investing the money. An unfunded plan, it doesn't matter. There's no funding. But if the employer earmarked outside of any contract, then the investments don't matter because it's an unfunded and owned and registered to the employer and taxed at the employer level. This is not a deferred asset. These are not protected assets. It's just an asset that the organization owns, just like property, plant, equipment, or cash. It's going to be taxed. And because it's not legally sequestered for the benefit plan, they can do whatever they want to do with it. And this is important. For all of you that run 457Fs, and for any of you that may be fortunate enough to have an F, please remember this. Participant investment horizons may preclude more volatile investments. I was working with a large hospital here in California, and when they hired me, I looked at the investments they had in their 457F plan. Now, their plan document deferred a benefit for 3 years. That was it. So the people that were getting the benefit Every year they got a contribution, and 3 years later that contribution had to be distributed, and it was a rolling contribution distribution schedule. So I asked the plan sponsor if they felt it was appropriate to have small cap stock investments in a plan that was going to be forced out in 3 years. They said, well, we want to leave that decision to our executives. But when I came back the next quarter and looked at the assets, all the assets were out of the stock plans, because the people on the committee were the ones that had the benefit, and they, I don't think, realized, or at least hadn't thought about the fact that stocks can go down, and in a 3-year period, vesting schedule, how long that money is going to be there, you may not want to put that in equities or volatile positions just because, well, March of 09 or March of 2020 could happen, and you just lost the entire benefit. Next slide, guy. So 457 plans can be a valuable reward or retention plan. Presentation tomorrow. You can probably download it now, put it in your folders, reference it. I've sourced a number of IRS sites. I've sourced DOL websites. Keep this presentation, keep this information in mind. If you have any questions, please feel free to reach out. And to that degree, we'll open it up. Does anybody have any questions?
Don't see any right now. You were a little glitchy through parts of that, Brian. So if someone has questions or needs additional information, we will be sending the materials out to everyone. We'll go ahead and include, when we do that, Brian's contact information and my contact information. So following the presentation, if anyone has a specific question or feels that they missed a piece in there, please feel free to reach out to us. I'm going to give one more minute for any questions to come in.
And yeah, the presentation will be emailed out tomorrow. Check your spam filter, or just anybody? Bueller?
No, I think we're going to go ahead and close it down. You ended there on actually a very long glitch, Brian, I hate to tell you. But I do want to thank everyone for their time. And again, if you have any questions, you'll get the materials, and please feel free to reach out to me or Brian. Thanks, everyone.
Bye.